Signal bars. Reversal bars. A reversal bar is one of the most reliable signal bars, and it is simply a bar that reverses some aspect of the direction of the prior bar or bars. If you look at smaller time frame charts, you will see that every bull reversal bar is made up of a bear trend bar and then a bull trend bar, but they don't have to be consecutive. The market had a sell climax followed by a bull breakout. Remember, all trend bars are simultaneously spikes, breakouts, and climaxes, but the context determines which property is dominant at the moment. The opposite is true of a bear reversal bar, where there is a smaller time frame bull trend bar, indicating that a buy climax took place, followed by a bear trend bar, indicating that the market broke out to the downside. Most traders want a reversal bar to have a body in the opposite direction of the old trend, but that is not necessary, and there are many other components of a reversal that should to be considered. The best known signal bar is the reversal bar, and the minimum that a bull reversal bar should have is either a close above its open, a bull body, or a close above its midpoint. The best bull reversal bars have more than one of the following: an open near or below the close of the prior bar and a close above the open and above the prior bar's close. A lower tail that is about 1/3 to 1/2 the height of the bar and a small or non-existent upper tail. Not much overlap with the prior bar or bars. 89. 90. Price action. The bar after the signal bar is not a doji inside bar and instead is a strong entry bar, a bull trend bar with a relatively large body and small tails. A close that reverses closes above the closes and highs of more than one bar. The minimum that a bear reversal bar should have is either a close below its open, a bear body, or a close below its midpoint. The best bear reversal bars have an open near or above the close of the prior bar and a close well below the prior bar's close. An upper tail that is about 1/3 to 1/2 the height of the bar and a small or non-existent lower tail. Not much overlap with the prior bar or bars. The bar after the signal bar is not a doji inside bar and instead is a strong entry bar, a bear trend bar with a relatively large body and small tails. A close that reverses closes below the closes and lows of more than one bar. This final property is true of any strong trend bar, such as a strong breakout bar, signal bar, or entry bar. For example, at the bottom of a bear leg, if there is a bull reversal bar and its close is above the close of the past 8 bars and its high is above the high of the past 5 bars, this is usually stronger, depending on the context, than a reversal bar that has a close above only the close of the prior bar and is not above the high of any of the recent bars. The market can trend up or down after any bar, and therefore every bar is a setup bar for both a long entry and a short entry. A setup bar becomes a signal bar only if a trade is entered on the next bar, which becomes the entry bar. A setup bar in and of itself is not a reason to enter a trade. It has to be viewed in relation to the bars before it, and it can lead to a trade only if it is part of a continuation or reversal pattern. One of the most difficult things for new traders is that a signal bar often seems to suddenly appear out of nowhere in the final seconds before the bar closes, and at times and locations that just don't make sense until several bars later. A key to trading is to be open to the idea that the market can start a swing up or down on the next bar. Just like the best chess players think several moves in advance, the best traders are constantly thinking about reasons why the market might go up or down on the next bar and next several bars. This puts them in a position to anticipate signal bars so that they are ready to place orders if a good setup quickly develops. Since it is always wisest to be trading with the trend, a trade is most likely to succeed if the signal bar is a strong trend bar in the direction of the trade. Remember, you are looking for times when there will likely be an imbalance between buyers and sellers above or below the prior bar. A reversal bar in the right context. Signal bars, reversal bars. 91. Is such a time, giving traders an edge. Even though you are entering after only a one-bar trend, you are expecting more trending in your direction. Waiting to enter on a stop beyond the signal bar requires the market to be going even more in your direction, increasing your odds of success. However, a trend bar that is in the opposite direction can also be a reasonable signal bar, depending on other price action on the chart. In general, signal bars that are doji bars or trend bars in the opposite direction of your trade have a greater chance of failure, since the side of the market that you need to be in control has not yet asserted itself. However, in a strong bull trend, you can pretty much get long for any reason, including buying above the high of a strong bear trend bar, especially if you use a wide enough stop. The stronger the trend, the less important it is to have a strong signal bar for a with trend trade, and the more important it is to have a strong signal bar for a counter trend trade. It is always better to get into a market after the correct side, bulls or bears, has taken control of at least the signal bar. That trend bar will give traders much more confidence to enter, use looser stops, and trade more volume, all of which increase the chances that their scalper's target will be reached. Reversal bars can have characteristics that indicate strength. The most familiar bull reversal bar has a bull body, it closes well above its open, and a moderate tail at the bottom. This indicates that the market traded down and then rallied into the close of the bar, showing that the bulls won the bar and were aggressive right up to the final tick. When considering a counter-trend trade in a strong trend, you must wait for a trend line to be broken and then a strong reversal bar to form on the test of the extreme, or else the chances of a profitable trade are too small. Also, do not enter on a 1-minute reversal bar, since the majority of them fail and become with trend setups. The loss might be small, but if you lose 4 ticks on 5 trades, you will never get back to being profitable on the day. You will bleed to death from 1,000 paper cuts. Why is that test of the extreme important? For example, at the end of a bear market, buyers took control and the market rallied. When the market comes back down to the area of that final low, it is testing to see whether the buyers will again aggressively come in around that price, or they will be overwhelmed by sellers who are again trying to push prices below that earlier low. If the sellers fail on this second attempt to drive the market down, it will likely go up, at least for a while. Whenever the market tries to do something twice and fails, it usually then tries the opposite. This is why double tops and bottoms work, and why traders will not develop a deep conviction in a reversal until the old trend extreme has been tested. If a reversal bar largely overlaps one or more of the prior bars, or if the tail extends beyond the prior bars by only a couple of ticks, it might just be part of a trading range. If so, there is nothing to reverse, because the market is sideways and not trending. In this case, it should not be used as a signal bar, and it even might turn. 92. Price action. Set up in the opposite direction if enough traders are trapped. Even if the bar has the shape of a perfect bull reversal bar, since no bears were trapped, there will likely be no follow-through buying, and new longs will spend several bars hoping that the market will come back to their entry price so they can get out at break-even. This is pent-up selling pressure. When the Zainal Baraslaj and Thassalotov overlap with the Priort with 3 bars, it is part of a trading range. This is a common situation in bull and bear flags, and it traps overly eager with trend traders. For example, consider a market that has been in a trading range day until it reverses up strongly to just above the moving average. Then it goes sideways for 3 bars and forms a strong bull reversal bar. If the entry would be maybe a tick or so below the top of the bull flag, it is tempting to buy, but about 60% of the time, this is a bull trap and the market will turn down soon after entry. How much overlap is acceptable? As a guideline, whenever the midpoint of a bull reversal bar is above the low of the prior bar in a possible bull reversal, or if the midpoint of a bear reversal bar is below the high of the prior bar in a possible bear reversal, the overlap might be excessive and be indicating that a trading range is developing instead of a tradable reversal. This is far more important when you are looking to enter countertrend, attempting to pick the reversal of a trend instead of with trend at the end of a pullback, when you have to be much less fussy about perfect setups. If the body is tiny so that the bar is a doji but the bar is large, it usually should not be used as a basis for a reversal trade. A large doji is basically a 1-bar trading range, and it is not wise to buy at the top of a trading range in a bear trend or sell the low of a trading range in a bull trend. It is better to wait for a second signal. If a bull reversal bar has a large tail at the top or a bear reversal bar has a large tail at the bottom, the countertrend traders lost conviction going into the close of the bar, and the countertrend trade should be taken only if the body looks reasonably strong and the price action is supportive, like a second entry. If the reversal bar is much smaller than the prior several bars, especially if it has a small body, it lacks countertrend strength and is a riskier signal bar. However, if the bar has a strong body and is in the right context, the risk of the trade is small, 1 tick beyond the other side of the small bar. In a strong trend, it is common to see a reversal bar forming and then seconds before the bar closes the reversal fails. For example, in a bear trend, you could see a strong bull reversal bar with a big down tail. A last price the bar hasn't closed yet well above its open and above the close of the prior bar, and the low of the bar extending below or overshooting a bear trend channel line, but then in the final few seconds before the bar closes, the price collapses and the bar closes on its low. Instead of a bull reversal bar off the trend channel line overshoot, the market formed a strong bear trend bar and all of the traders who entered early in anticipation of signal bars, reversal bars. 93. A strong bull reversal are now trapped and will help drive the market down further as they are forced to sell at a loss. A big bull reversal bar with a small body also has to be considered in the context of the prior price action. The large lower tail indicates that the selling was rejected and the buyers controlled the bar. However, if the bar overlaps the prior bar or bars excessively, then it might just represent a trading range on a smaller time frame, and the close at the top of the bar might simply be a close near the top of the range, destined to be followed by more selling as the 1-minute bulls take profits. In this situation, you need additional price action before entering a counter-trend trade. You don't want to be buying at the top of a flag in a bear trend or selling at the bottom of a bull flag. Computer programs allow traders to use charts based on a wide range of characteristics of price action. Traders use every time frame imaginable as well as charts where each bar is based on any number of ticks. Each individual trade of any size is one tick or contracts traded as well as many other things. Because of this, what appears to be a perfect reversal bar on a 5-minute candle chart might not look anything like a reversal bar on many other charts. And even more important is that every reversal on any chart is a perfect reversal bar on some other chart. If you see a reversal setting up but there is no reversal bar, don't waste your time looking around at dozens of charts for one where there is a perfect reversal. Your goal is to understand what the market is doing, not to find some perfect pattern. If you see that the market is trying to reverse, even if it is doing so over a dozen bars, you need to find some way to enter the market, and that has to be your focus. If you waste time searching other charts for a perfect reversal bar, you are allowing yourself to be distracted from your goal and you are likely not mentally prepared at the moment to be trading. Most reversal bars on the daily chart come from trending trading range days discussed in Chapter 22 on the intraday charts, but a few come from climactic intraday reversals. Whenever traders see a trending trading range day, they should be aware that it might have a strong reversal later in the day. 94. Price action. Figure 5.1. Figure 5.1 reversal bar in a trading range. As shown in Figure 5.1, reversal bar 1 largely overlapped the 4 prior bars, indicating a two-sided market, so there was nothing to reverse. This was not a long setup bar. Reversal bar 2 was an excellent bear signal bar because it reversed the breakout of reversal bar 1. There were trapped longs here off that bull reversal bar breakout, and it also reversed a breakout above the bear trend line down from the high of the day. The trapped longs were forced to sell to exit, and this added to the selling pressure of the shorts. Astute traders knew that there were more sellers than buyers below the low of bar 2, and shorted there, expecting at least enough follow-through selling to be able to make a scalper's profit. When the market is in a trading range in a downswing, it is forming a bear flag. Smart traders will look to sell near the high, and they would buy near the low if the setup was strong. As trite as the saying is, buy low, sell high, remains one of the best guiding principles for traders. When I say buy low, I mean that if you are short, you can buy back your. Figure 5.1. Signal bars, reversal bars. 95. Short for a profit, and if there is a strong buy signal, you can buy to initiate a long position. Likewise, when the market is toward the top of the range, you sell high. This selling can be to take your profit if you are long, or if there is a good short setup, you can sell to initiate a short position. Deeper discussion of this chart. The market broke below yesterday's low in Figure 5.1, but the breakout failed and reversed up into a trend from the open bull day. The bull trend ended with a strong breakout that failed at 7:48 a.m. Pacific Standard Time with a moving average gap bar short setup. The move down to bar 1 was a tight bear channel, and the first breakout above a tight channel usually reverses within a bar or two. At that point, it might form a lower low or higher low pullback from the breakout, and then the rally will resume, or the breakout will simply fail and the bear trend will resume, as it did here. 96. Bars with big tails and small bodies must be evaluated in the context of the prior price action. As shown in Figure 5.2, reversal bar 1 was a breakout below a prior major swing low in a very oversold market. It reversed up from a breakout below the steep trend channel line of the prior 8 bars. There had also been very strong bullish activity earlier in the day, so the bulls might return. Profit takers would want to cover their shorts and wait for the excess to be worked off with time and price before they would be eager to sell again. The next day, reversal bar 2 overlapped about 50% of the prior bar and several of the bars before that, and it did not spike below a prior low. It likely just represents a trading range on the 1-minute chart, and no trades should be taken until more price action unfolds. Although a classic reversal bar is one of the most reliable signal bars, most reversals occur in their absence. There are many other bar patterns that yield reliable signals. In almost all cases, the signal bar is stronger if it is a trend bar in the direction of your trade. For example, if you are looking to buy a possible reversal at the bottom of a bear trend, the odds of a successful trade are significantly increased if the signal bar has a close well above its open and near its high. Figure 5.2. Signal bars, reversal bars. 97. Deeper discussion of this chart. Today, the most recent day on the chart shown in Figure 5.2, broke out above yesterday's trading range, but the breakout failed and the day became a trend from the open bear. The second breakout below yesterday's low also failed and became the low of the day. When the market goes sharply up and then down, it usually enters a trading range, and the bulls and bears then fight for control of the market. The move to the new low of the day accelerated at the end. There were a couple of large bear trend bars, which were consecutive sell climaxes. This usually is followed by at least 2 legs and 10 bars up. Because the sell-off to a new low had no follow-through, it was simply due to a sell vacuum and not strong bears. The strong bulls expected the market to test below the low of the day, so they simply stopped buying until the target was reached. Their lack of buying during the several bars leading to bar 1 caused the market to collapse. It did not make sense for them to buy just above the low when they believed that the market was going to fall below the low. Why buy when you can buy lower if you just wait for a few minutes? However, once it reached their buy zone, they bought relentlessly, and the market rallied in a bull channel into the close. 98. Price action. A bear reversal bar does not have to have a high that is above the high of the prior bar, but it does need to reverse something about the price action of the prior bar or bars. In Figure 5.3, bar 29 was a strong bear trend bar in a bull leg, so its body reversed the direction of the market. Its close reversed the closes of the prior 13 bars and the lows of the prior 12 bars, which is unusual but a sign of strength. All of the traders who bought on the close of bar 24 and during any of the next 12 bars now quickly were holding losing positions, and if they did not exit as the bar was forming, they would likely have exited on its close or once the next bar traded below its low. The strongest bulls hold through pullbacks and will hold until they believe that the trend has flipped. A single strong reversal that reverses many closes and lows, like bar 29, can flip the always in direction. It can also lead those strong bulls to believe that the market will likely trade low enough so that they could exit their longs and then look to buy again much lower, probably as much as a measured move down based on the height of the bar. These disappointed bulls will look for any opportunity to exit their longs. They expect to get out with a loss at this point, but would like to get out with as small a loss as possible and will place limit orders above the close of bar 29 and above the high of prior bars. Some traders will see the prior bar as a high one buy setup, but this is a situation where traders believe that the always in direction has reversed to down. They therefore think that high one and Figure 5.3. Signal bars, reversal bars. 99. High 2 entries will fail to yield even a scalper's profit. Both the bulls and bears will place limit orders to sell above these high 1 and high 2 signal bars, entering on limit orders on high or low 1 and 2 signals that you expect them to fail is discussed in Book 2. The bulls will be relieved to get out with a smaller loss, and the bears see this as a great opportunity to short above the high of the prior bar in a new bear trend. It might be a bear channel, but if the market falls below the high 2 by signal bars low, even the most diehard bulls will give up, and the market will often break out into a bear spike and then at least a measured move down. If there is no pullback that would allow the trapped bulls to exit with a smaller loss within a few bars, they will exit at the market and on the closes of bars that have bear closes and on stops below the low of the prior bar. Bears understand what is happening and will look for those same opportunities to sell, but their selling will be to initiate shorts, not to exit longs. The bulls who held through the close of bar 29 are the swing bulls, because they were willing to hold through pullbacks. Swing traders are generally the strongest participants, because many are institutions with deep pockets and have the ability to tolerate pullbacks. Once these strongest bulls decide that the market will fall further, there is no one left to buy, and the market usually has to fall for about 10 bars and 2 legs to some support level before they will consider buying again. They will not buy until a strong buy setup appears, and if one does not come, they will continue to wait. Here, there were not enough bars left in the day for them to look to buy again, and therefore there were not enough buyers left to lift the market before the close of the day. Bar 29 was a signal bar, and many traders shorted below its low. It was also an entry bar, and many traders shorted during it as it fell below the low of the prior bar and as it was expanding down, because they believed that the breakout above the trading range of the past 12 bars was failing. It was also a breakout bar because it broke out of that trading range to the downside. It formed a reversal with bar 27 or with the entire bull spike from bar 26 to bar 29. From the inset, you can see that it was part of a large reversal bar on the 15-minute chart. Bar 21 reversed the closes off her prior 3 bars, but since it was a nasty bear channel, it was safer to wait to buy a breakout pullback after the market broke above the channel. Also, it overlapped the prior 2 bars and might be forming a trading range instead of a reversal. Bar 23 was a reasonable breakout pullback signal bar, since the market just made 2 attempts to sell off and both failed bar 11 and the bar before bar 23. Because the day had such a strong rally in the first couple of hours, the market was likely to try to rally again after a pullback. This increased the chances of success for traders who bought above bar 21, especially since it tested the initial breakout above the opening range, the high of bar 1, and reversed up. Bar 21 was signal bar, but the bar that followed was a doji bar, which shows a lack of urgency by the bulls. Bar 25 was also a signal bar, and the next bar was a 100. Price action. Figure 5.3. Inside bar. Whenever the bar after the signal bar is a small doji bar, the market lacks urgency for a reversal. If the bar is an inside bar, like after bar 25, it is usually better to not take the trade unless the setup is otherwise especially strong. If the doji is the entry bar like after bar 21, you have a few choices. You can try to get out at break-even or with a 1-tick loss, or, if the setup otherwise looks good, you can keep your stop below your signal bar. Since this looked like a good setup, it made sense to hold long with a stop below the signal bar. The bar after bar 19 was a doji, but bar 19 was a weak signal. When the entry bar after a weak signal is also weak, it is better to try to get out around break-even. In general, raising the stop to just below a doji entry bar is not a good choice because the odds are 50-50 it will get hit. If that is what you are inclined to do, it is probably better to try to get out around break-even. Whenever there is a doji bar within a few bars of a reversal, the market has about a 50% chance of trading below it. Also, when you are trading reversals, you are trading countertrend and the odds of a pullback are high. If you take the trade and it looks strong, you have to be willing to allow pullbacks or else you should not take the trade. If the setup instead is weak, you want a very strong entry bar, and if you do not get one, consider trying to get out with a scratch break-even or maybe a 1 or 2 tick loss. There was our strong bull trend bar 2 bars after bar 13, and since it is a reversal bar, it can be viewed as a signal bar. It was followed by an inside bar, which can be thought of as a breakout pullback. However, since that strong bull signal bar has so much overlap with the 2 prior bars, it probably had a 60% chance of being a bull trap, which it turned out to be. Bull flags just above the moving average where there are 3 or more large bars that mostly overlap are usually traps. The same is true for a bear flag just below the moving average where there are 3 or more large bear bars that largely overlap. Even if there is a strong bear trend bar for a signal bar, the odds are that a short below will result in a loss. Between bars 10 and 15 there were several bars with strong bear bodies, and this was a sign of selling pressure. The pressure is cumulative, and it eventually led to a sell-off. CHAPTER 6.